Dan, good to see you again.
Good to see you too, Carl.
You had said a few weeks ago that cash was a position, and I wonder how would you grade yourself in leveraging this recent rally we've had?
It's gone pretty well. I mean, if you go back and you look at our Twitter posts, we talked about the fact we thought a short-term rally would be coming. We bought some stocks like in the fintech space to benefit from that. Markets rallied, and we've started putting back on shorts. We actually now have, again, as many shorts as we have longs on. And so I think this is kind of the tape we're expecting. You get bear market rallies, you get sell-offs, you get bear market rallies, you get sell-offs. I think it's going to be, 1 to 2 years before this is sorted through, because for the first time in a long time, the Fed is your enemy and not your friend. And I think people are forgetting that mantra: don't fight the Fed. Worked great on the way up. It's unfortunately probably going to work well on the way down as well.
How are you determining what the high end of the channel looks like? What is special about the levels we're at here that puts you to normalize your shorts and longs?
Well, we've got about 17 different technical indicators we use, and the bottoms are actually a lot easier to pick with technical indicators. But when you're looking at prior periods of bear markets, and we've analyzed about 10 of them where they've gone down about 30% or more, you typically get back about 70% of whatever you lost on the prior leg down. About 20% of those rallies, you get back all of the prior leg down. And so that gives you a starting point of you going, all right, you know what, this is when technically I should start putting those on if nothing about the fundamentals that I'm looking at have changed. And nothing on the fundamentals have gotten better. In fact, they've gotten worse. You've got higher oil prices, higher commodity prices. Guys are starting to cut numbers. You're getting towards the end of the quarter. You're going to see the impacts from Europe. And so from that standpoint, we saw somebody cut their estimates on Amazon this morning by 15% because of oil for profits for the year. So you're going to see more of this stuff. And from our perspective, the Fed has just gotten started. So it makes it a lot easier when you've analyzed all the data going back in time.
Hey, Dan, it's John. You mentioned Europe. It's actually the subject of my On the Other Hand this morning. I hope you can spend some more time there, because we just saw Adobe take a dive yesterday post-earnings. A big part of that was because of kind of pulling back on revenues out of Russia, Belarus, Ukraine, et cetera. And then I'm hearing more cautious commentary from the likes of Volkswagen Group, companies that are based in Europe versus just global, multinationals who have some business in Europe. The ones who are closer to Europe seem to think that the economic impact in Europe is going to be bigger and flow through to more other places. How much do you think the market is considering that already, and how much should investors be thinking about it from here?
This is a great question, John, because think about Adobe. They're a category leader. They make tons of money, very profitable, and the stock was already down 33% going into their earnings release yesterday. And by the way, they'd had 2 prior quarters that were poor as well. So it wasn't like expectations were that high. Then they reported, said, hey, by the way, now remember, Adobe's quarter ends in February, and Russia invaded the Ukraine on February 24th. Most of these companies are going to report the quarter, their quarter ends in March. So you're going to have an extra month where things are slowing down. Adobe still got hit for 9% yesterday after being down 33% from its all-time high going in with 2 prior bad quarters. So for the rest of these companies, I think you've got a much bigger issue. You've got an extra month worth of data. Europe's a very important region for a lot of the bigger companies out there. And, I don't think investors are really paying attention to that, or oil prices for that matter, because that matters, and wages. Don't forget, 2/3, actually close to 80% of the U.S. economy is now services-based, and we just saw the lowest jobless claim number in 50 years, and there's 3 million more job openings than there are people unemployed. That's going to keep wage pressure really high as well for a lot of these names. So, and multiples are still very high at a 23 times trailing PE.